All right. Good morning, everybody. Kind of got a busy day. It's not that bad, I think. The the big question is whether it's gonna stick. So right now, China down about a half of a percent. The U.S. markets are basically flat, sitting green. Small caps trying to make a little bit of a run in the pre-market, and Japan up more than a half of a percent. So if you imagine that wave that kind of goes around the world, starts in Australia, then we get the Asian Open, and then Europe, then we come in, the day's half done, and we really don't have a lot to show for it. So we need to play catch up. We're going to get some jobs data today that goes to the heart of the Fed's dual mandate. Any jobs data whatsoever, you want to pay particular attention to it. There's some issue with the government shutdown. It's going to mess with some of the data. They're also changing the way that the data is tabulated. This is kind of in the weeds and a little bit nerd. So, if you don't speak math, then just chin up, suck it up, and, take some time on your own to learn some math because the formulas are important. So they're going to change the way that the formulas are run, and that's going to give us a different number at the end of the formula. That's going to spook a lot of people who don't understand this. Do they say that smart money is smart, but they're not? If you've been in this game for a while and you've met any of these so-called smart money managers and large fund managers, they are not smart. They're not sophisticated traders. They just know this one niche thing, and that's all they can do. And people are people who continue to tell me all the time they don't like math or they suck at math and they don't want to do it. They don't want to learn it. So these job numbers aren't going to just freak out the average everyday Joe sacking your groceries trading on Robinhood. They're going to freak out a lot of people who think they're traders. They're really not. They just mimic somebody else or they just do this one little niche thing. They're going to see these numbers. The numbers are going to be off very likely, and that's going to cause some shenanigans for a little bit. So things will stabilize when we get the new formula long enough, then it will become the norm and it won't be such an outlier. And for all we know, the number won't be that bad, right? That's the thing. We don't know what the outcome is. So prepare for some uncertainty when we get the data today. We do have some Fed speakers running their mouth, chipping teeth. And we're going to get some crude inventories data, which goes to the Strategic Petroleum Reserve and the government's stranglehold on energy prices. Almost sounds like a conspiracy. Just because you're paranoid, it doesn't mean they're not out to get you. We got the auction today. It's the 10-year. For years it seemed like I was the only one pounding the table about these auctions. And one of the problems with it is, as with anything else, sometimes the auctions go by and it's no big deal, doesn't even cause a ripple. And so people get tired of looking at it and they don't pay attention. And then we end up getting some auctions, monies moving through there that really rocks the boat. Me, I've got a habit of just paying attention to when we've got these auctions coming in and just recognizing what time it is in the day so I don't get run over. just like with your pets, maybe you shouldn't have favorites, but I do like the 10-year. It's near and dear to my heart. We're going to get that today. So we've got a lot of stuff just coming in, right? We're going to need to be nimble and flexible. Don't get stuck with one bias and not update your point of view, right? We're also going to be getting stuff out of the White House today, just because why not, right? As if we didn't have enough going on, might as well just throw that log in the fire. So this is the FedWatch tool. It's free, doesn't cost you anything. You can just Google FedWatch. It's from the CME group, so if you look at all the results from Google, you know which one to pick out. You can choose the FOMC that you want to look at here. And then down below, you can see how it's changed. I know it's not your typical chart, but it's not that complicated if you just give it a little bit of your time. A little tip to make it easier to read is just pick one number. If we are at 375, then just when you read this, current target rate is 375. That way, when you come down below, you can see the current rate, 375, and is it increasing or decreasing? And these are the probabilities of a rate cut, or the probabilities of where we will be at that meeting. So from March, we can see the current rate, 375. It's kind of gone up barely. It's a minuscule amount, a 0.5%. June, it's gone down 1%, which is nothing, right? This is waves when you toss a pebble in the water. But you do want to keep your eye on this. If there are significant changes and you don't look, then I promise you won't see it. It's kind of the idea, right? A lot of the tools that we look at, there's just nothing there. So we don't need to squint and read the tea leaves, try to anticipate, read between the lines. If there's nothing there, move on. But keep your eye on it, because if you've ever wondered how people know that something is priced into the market, or how they know that something's getting unwound from the market, it's because of stuff like this. So are they pricing in a new rate cut somewhere? Are they unwinding a rate cut that was already priced in? You would see it in this data, right? That kind of sounds important, doesn't it? So figure it out. If you don't know, you don't understand, ask questions. I'm sure there's plenty of people that will help in the chat. And I will continue to reiterate, if this new PAL replacement is supposed to be some presidential puppet who's just going to run around and do exactly what the president wants, where's all the rate cuts that this puppet would be piling into the market? They're not showing up. So he must not be that big of a lapdog, or the market just doesn't believe he's going to have the juice to get it done, because they're not pricing it in. Of course, it's probably just the public narrative, right? That Madagascar cyclone was nuts. Those people really took a beating. All right, White House scheduled risk probabilities is high, 72 out of 100. So watch the clock. Keep your eye on Twitter or whatever social media you want to use. There's a Netanyahu meeting today that's got a lot of people's attention. Uh, there's supposed to be a, a briefing, I thought, this afternoon. I'm not seeing the briefing in here, but I thought there was also supposed to be a briefing. But Netanyahu at 11. So right after we get crude oil inventories, it's going to be like that all day today, guys. Every time we get past one event, we just get to look down at the next event coming at us, and then the next one, and the next one. OxyClean. What'd you do? Stay up too late buying a bunch of junk on infomercials? All right. I don't show this often, but it's worth having a short discussion about it. This is what we call, well, what I call a liquidity gap. The idea behind it is it can happen anywhere, it can happen at any time. There is no gap in price, right? But when you get an economic event or just a big headline that comes in, you can get an outsized bar. It can go up, it can go down. I don't really care about what direction it goes. I just care what it looks like. If you look at the bars that we were getting before we got the big event bar here, this bar is way bigger than those. I don't really need a statistical measure to say, it needs to be X% larger. It should stand out. If at some point in your trading day we get this really big bar, let's just call it an oh damn bar, where you look at it and it pops and you say, oh damn, well, that's big enough. Mark that. So it is easier to identify these when they land on an economic calendar, CPI, PPI, non-farm payroll, something like that. You're watching the clock, the data hits, you get a big bar, there's your oh damn bar. Now you can mark that bar, track it from its highest point to its lowest point, mark the midpoint, and then use the fib projections or the quadrant lines. And if you notice, I didn't put them on here, but we stopped at about 50% of that bar if we had measured it higher. When we retraced to 50% of that bar. What I'm looking for is a liquidity gap close. That means we go back to where the candle opened. Some of the rules that I want to see is that there's no wick going in the opposite direction and the candle closes in the upper 25%. Now, what I mean by that is if this candle was broken down into 4 parts, just like a dollar has 4 quarters, then in the top 25%, that's where I want to see price because this candle went up. If we had gone down, then I would want to see price close in the lower 25%. That's the idea behind it, right? So not much wick going in the wrong direction, big candle, and it closes in the upper 25%. Now, in this image that we're looking at right here, price did not get this gap closed. So we got the big liquidity gap. We checked at 50%. We retraced to the half back, but we never got the candle closed. This is an example of getting that gap closed. So 8:30 print came in, big move, price closed in the upper 25%. We spent the rest of the morning working our way down and we got back to where we started between 10:30 and 11 o'clock. We did pause on that halfback, by the way. So if that was all we were going to get, that would have been a really good place to flip it and run it long. And it was a very nice 3-bar reversal there. I mean, what a beautiful example of a swing low. That didn't turn us around, but I mean, if I was looking for, some pinup posters, that's a really great example of a reversal pattern. So this is what we're looking for today, is getting one of these really large bars and then coming back to where that bar started. Here's an example going in the other direction, because like I said, I don't care if it goes up or down. There's not much wick going in the wrong direction. We close in the lower 25%. We paused, put in a bit of a base, and then we worked to get the gap closed, which we did get closed sometime between 10:30 and 11, right before lunch, really. Here's another one. This one happened to be CPI, but an 8:30 print. We closed in the upper 25%, and then we paused inside of that wick structure, broke out, continued the move, put in a topping pattern, worked our way back down, got the gap closed between 10:30 and 11 o'clock. Start to get the idea there, right? We're not looking for an immediate gap close. I don't want to see a candle pop at 8:30 and get back down to where it opened by 8:45. It's not what I'm looking for, right? This should take time. So getting back to the gap close around 10:30 or 11 o'clock, that's kind of what I'm focused on. Now, if you are a destination trader, as I often am, and you're using pivot points, then you can recognize the multiple opportunities to get another bite of the apple, right? Because you've got an idea where we're going, and you just look for another opportunity to get in and make some money on the journey. These big bars don't have to do what we want it to do, right? Because price can do whatever the hell it wants. Hopefully you've learned that by now. And if you haven't, well, stick around. It'll teach you. So what if we get a really big bar today, but it's not one of those really pretty bars that I was just showing? Big wicks on each side and price closes really close to where it opens. Well, if we close where we opened, then there is no gap to close, right? We don't need to do anything. But that doesn't make the candle worthless. We can still mark its high and its low and its mid, and then we can run our projections above or below. And if we had done that with this candle, we'd see that that was very likely the 50% that we were tagging out across that high here. Even on the pullback, hitting the midpoint of that event bar is very likely where we shut down here. So we can still use these bars. Now I'm showing calendar event bars, but these can happen anywhere at any point during the day. If you're a swing trader, then you can look at these outsized bars on, whatever time frame you want. You can find them on daily bars, weekly bars. The idea is that you have an outsized bar, preferably an event bar, and then you can use that for your measurements. Here's another example of what I don't want to see if I'm looking for a liquidity gap close. Big wicks in each direction, price closed near where it opened. So we can measure this and we can project its half and its full. We can also mark the midpoint and anticipate price reacting at that mid on its way back. Another example. So you get the idea, right? There's a lot of these out there. This is just a couple that I've collected just to be able to have conversations about it, point out what it is that we're looking for. Liquidity gap close. Well, that's bright. So I don't know that we're going to get a big bar, right? I'm not trying to anticipate or tell you that we're going to get a big bar, just that when you have economic data on the table, you could end up with a big bar, and that big bar is not worthless. You can use that. I'm not necessarily interested in trying to guess which way the bar is going to move. I'd rather let the bar print and then mark that bar out and use what it has to offer us. Trying to guess the direction of non-farm payrolls is about as worthless as trying to guess what a company's earnings is going to be. And that's all it is a guess. I like my money. I'm not going to guess with my money. So you do you. So let the event happen, measure the bar, and then go from there. Remember, the gap should close by 10:30, 11 o'clock. It should take time to get that gap closed. And in the very first example, we had the perfect bar and it never closed, but it still responded on the midpoint of that bar and the projection of 50% of that bar, right? Instead of the 111 and the 1236, price broke above that bar and went to 50%, because with event bars, we run 50s and 100s, not 11s and 123s. So this morning we're sitting in a tight range within our Globex. We wicked outside of yesterday's range and came back in again, so that's our inside day breakout failure. Now that we've come back in, we really want to keep it. If we look what's underneath this, we've got the 3-week, the 10-day, and the 20-day, and the 3-week, the 3-day. They're all piled up there. 3-day, 3-week, 10-day, 20-day. And they're all piled up right at that 69.50 options level. Now make no mistake about it, we can still break that level, because we don't consider all of those moving averages as a structure of support. They're just a line in the sand. We checked that 3-week moving average yesterday. That was the reversal off the low in power hour. And then we broke yesterday's low on this drop earlier today through the kill zone. Well, at the end of after the kill zone. As it usually is, today, just like all the other days, we got to get out of the box. And right now, that's the box we have to get out of. On a move back to the upside, we got the half back of yesterday that we can focus on. And then we have the Globex high. Then we focus on yesterday's levels. Overnight volume at 75,000 is just slightly above the normal volume. And this kind of goes to something that's been bugging me a little bit this week. The weekly range that we looked at on Friday and that we re-examined on Monday, it didn't tell us that there was an event this week that the market was worried about, right? I talked about this a little bit on Friday and on Monday, how we didn't have a hurry up and wait environment being priced into the market this week. So the market didn't really seem to care about non-farm payrolls, which is odd. I give it that. And then today we've got normal volume. If the market was really concerned about non-farm payrolls, volume should have been light. They should have been sitting out in front of this print. And they didn't. It's average volume. And in fact, it's a little above average volume. So if this was a normal non-farm payroll that the market was concerned about, we would see a market maker move up here today. And we don't have one of those either. So we didn't get the narrow range for the weekly expected move. We didn't see the light volume this morning as they sat out anticipating a big price move based on the event. And there's no market maker move, so they're not adding additional hedges this morning. Now, maybe we're going to get some numbers that are offsides and freaks everybody out, and we get a big move because they're not expecting something. So that means they'll be caught offsides. The other side of that coin is that this non-farm payroll print is a big old nothing and nobody out there cares, and the data is going to come in, we don't get a big move at all, and the market just moves on to the next thing that it needs to focus on today. So if we don't get a big move, well, that won't be a surprise to the big money, because from everything we're looking at, they're not expecting a big move today. We are sitting in between the ADR lines. We haven't done anything, which makes sense. That's what we would expect into a big binary event like this, is that the market sits and just goes sideways while we wait on data to come in. That's a really nice thumbnail, isn't it? He did a good job with that. K-State purple, baby. All right. The central pivot range and the floor pivots for today. Today's floor pivot is higher than yesterday. That's bullish. Price opened underneath it, and that's bearish. They kind of cancel each other out. The range today for that central pivot is narrower than the range from yesterday, but it's not a narrow range, right? It can get so narrow that all you see is the purple line. Now that's narrow. It's not that narrow, right? We got plenty of range here that we can see. Narrow channels imply that if we break out, we could really run. But a wide channel implies if we break out, we likely just come back inside the range again. Keep in mind that these channels don't make price do anything, so they're not going to make us break out. They won't stop us from breaking out. And if we do get a breakout, it won't turn us around and make us come back in again, right? So the width of that channel is for analysis purposes only. We just use it to try to better understand what is likely to happen if we got a breakout today. Because of the narrow range, it's very likely that our S&R lines for today are going to be really close. We are likely to hit those before we even get to the ADRs. So those would be the earliest levels to hit, 69.50 on the downside and 7,000 on the upside. If we try to make a move back up, we're going to have to work through the central pivot channel. And then that mid, the RTH open of yesterday, the R1, yesterday's high, on and on, right? We didn't quite get to yesterday's 111. So we don't even have that yet. We got close. Hand grenades and horseshoes, right? All right, the distribution for the week is looking pretty good. We talked about this level up here earlier this week, that high volume node. And that's what we've interacted with so far. There is still the potential for a lot of liquidity there, especially since we didn't close above that level. So if we did make a run to the upside today, we got to get through this week's point of control, the value area high. Then we got to check the high of yesterday, which is also a high volume node from last week. We can get through that level, but it's going to take some serious juice to get us there. To the downside, we've still got this point of control, 69.32 cog line. That should act as a bit of a structure, and below that, 69.11 cog line, which we haven't tagged this week, but we did leave a decent footprint behind last week. It does get narrower the lower we drop. So if we get below 69.50, then it should be easier to travel to the downside. And we're running 50s, right? Keep that in mind. So if we break 69.50, then 68.50 is on the table. Break that, we got 67.50 again. $10-day, 30-minute volume profile in TPO. The point of control now is lined up on both of these. The green profile, which is the volume profile, is still pretty ugly, all things considered. It's a nasty looking chart. It's going to take at least another week before we see this point of control shift to a new location. And it's likely that it goes up to that 70-20 zone. Can't tell for sure, right? But for now, there's no expectation that this is going to move at all. The good thing is we're on top of it. We're not underneath it. So we want to keep that. It's another level today that we really want to keep our eye on. It's that 69.60 level. Now, don't get me wrong. We can wick underneath it, right? We need to close above it on the day. That's kind of the big thing. And if we do get below it today, if we reach a point of no return where we've gone far enough below it that it just seems inconceivable that we would make our way back up through that level by the end of the day, then we can treat it as if the market has already closed below that level. The analogy is when you're swimming out at the lake, they tell you don't swim farther than you think you can swim back, right? Because you still got to make the journey back to get back to the beach. Well, if price has already traveled so far that it's not able to make the travel back inside the range by the end of the day, then you can go ahead and treat it as if the market has already closed outside of the range. We got a new VPOC from yesterday. Now, I don't generally get too hung up on trying to get this to the tick perfect. I just get it, close enough to the points. If you want to zoom in and do that, then you more than welcome to do that. The V stands for virgin or untouched, right? This is an untouched point of control. I don't name this stuff. That's just what it's called. It's in the books. So this VPOC level is over our head. If we do make that move to the upside, we're going to have to get through that level. Now, we don't need to put any bias into that statement, right? We don't need to call it resistance. If it was underneath us, we don't need to call it support because that's just putting some bias in there. But we can look at what it stands for. It's where the greatest amount of trading activity took place yesterday. That's not my feelings. I'm not guessing. That's just what it is, right? That's a fact. So if that's where the greatest amount of trading took place yesterday, there's an expectation that price could respond at that level if we was to go back and revisit it, whether we do it today, tomorrow, next week, which is why we want to mark that level and carry it forward until we finally do hit it. It's 69.90, which is really close to 69.92 cog line, so I already would be keeping track of the 92 anyways. As far as I'm concerned, I don't need it because it lines up on my cog line. But if you're not using cog lines, or you just, maybe you're some Canadian engineer or something, want to get a little anal retentive, then zoom in, mark it to the tick, and you do you. This morning's distribution is a bit broken. You can see they're forming these little pools. So we got multiple distributions in different zones, but no real effort was put in along these lows. We didn't turn around here because a bunch of buyers come in. We don't see any signal of that down here. Sellers just got exhausted. Still haven't broken this trend. We are less than 1% above the 10-week. We need to move farther than the 10-week is going to move if we want to maintain that distance above the 10-week. Right now, we're close enough to it that the pace of the tape is different. The size of the contracts that we see coming in are different. It's like the calm in the middle of a storm, or in the eye of the hurricane. As long as we're within this zone, we should see less volatility, a more normalized tape, and things should just run a little bit smoother. We begin to expand above or below that 1% mark, and then all bets are off. So elevated flows, increased tape speed, pulling and stacking will get more violent. But at this point, looking at what we've done on the week, that big move that we had with the reversal from Friday and then into this week, we're fine. Nothing's broke. And looking at the daily, I mean, we're above the daily, so there's that. But we're within this imaginary collar, 0.5% above and 0.5% below. There's another one at 1%, but we want to focus on the first one, the 0.5%. In that, it's kind of the same thing, the eye of the storm. So watch for price to expand away from the 10-day more than that 0.5% or more than that 1%, especially on the intraday. Looking at what's down this morning, we got China down. The ETF called IPO. It's a great ETF to use for a tool just to see what small caps are up to. That's down this morning. Nat gas, more China, Bitcoin, Bitcoin, Bitcoin. Looking at what's up this morning. What's up? Chips. Oddly enough, a little bit of China. EEM is a ETF. It's a basket of stocks, but the basket is mostly representing China. So typically when we see EEM, we just call it China, right? Because I mean, that's the most of the stuff that's in it. But this morning we got a little bit of a disagreement between the KWEB constituents, which is the China Internet ETF, and this ETF. So some of China is down, some of China is up. VIX is up, energy, generic energy, uranium, solar, so really a lot of energy. A very diverse energy pool is up. And then gold miners are leading the way. And over a 5-day period, they're not much greater than they are today, a couple of points. All right, so this is banks. This is regional banks, KRE. Been decent. All right, we're looking at it on a daily here, take it out to a weekly, and then the monthly. The monthly really highlights this restrictive level here, right? Above 75, kind of just that level we haven't been able to keep it above. But we're coming back up into that zone, careful of a reversal in this area, right? Beautiful breakout above 70. It's been this week we've been trying to keep the breakout from last week, right? So same thing as we always do, just take your big bar, mark the mid, kind of the line in the sand for the breakout. And if we was to carry that forward, to the left, it would closely resemble the line in the sand that we had on the breakout. Or if you're focused on the 111 and the 1236, oftentimes if a breakout is going to fail, it does so on the 11. This hasn't failed yet, but it's where we would expect a failure if that's going to happen. Even if we do keep it though, and we continue that push up into the 1236, it lines up with 75, that previous level from the monthly that we were looking at, as the level that we haven't been able to get and stay above. So keep your eye on financials. You can open up this ETF and get the names that are in it. That's not really the point. It's more the point of financials, right? It's the difference between the S&P and the NASDAQ is, the index that has the financials in it, S&P. We'll see what the day gives us. So it's all things considered, it's a pretty good day today, right? We've got a lot of things on the table calendar wise that could cause some shenanigans. There's plenty of opportunity. And we've been in a relatively decent range compared to the big sweeping moves that we had last week, right? Those were some pretty big days. Thursday and Friday, big massive days. So we're IX10 inside of this range. That's a little bigger than I would like. We're inside day of yesterday's range. That's what we got to get the heck out of, right? GTFO, get out of the box. So if we break to the downside, we've already got our levels. If we work our way up, say we get a trend line break over here, start working up, then get through the half, get through the top, then yesterday's levels. We'll focus on that ADR afterward. It's going to be choppy and nasty to the upside, or we could get, some reasonably decent price action, but I wouldn't expect it, right? It'd be nice to just get some good, clean price, with decent pullbacks and measured moves. But I kind of got this sneaky suspicion that it's going to be more of like one of those one-time framing bars where you just get a big, massive move and then, we stall out, which kind of sucks, right? So just let it play out, see which one we're going to get. If we go up, it's likely that we won't get any decent tradable price action until we get outside of yesterday's high. That's kind of the point I'm trying to make here, right? So if we break down, it's clean and clear. We've got awesome levels to the downside, and we don't have to fight any of that trash. But if we get that trend line breakover and we start working up, then it's likely that we don't get anything clean until we're outside of the high of yesterday. Unless you like trading this sort of trash, then maybe you'll like it on our way back up through that level of yesterday. So what I got for you guys, be careful, be safe, watch the clock, right? Watch the clock. I see y'all tomorrow. That is a good point about EEM. It's not just China. We've always just lumped it in there with China, right? But you do make a really good point, Mike. Thank you for that. I see y'all tomorrow.
Recording stopped.